I have a little one that just ran in the office.
Oh, your assistant came in
Want
to
to say
help?
hello? Oh,
What's
right.
up? Well, we had a cameo appearance today. There you go.
Of course, she's coming
Yeah.
in right before. So, anyways, but yes, here we go. Happy Thursday. So, what are we doing today, Keith?
Happy Thursday. Today's our Mortgage Nugget show. You know, we're doing a show every month about mortgage topics, and today there's been lots of splashy headlines going on between FHFA and FHA and extensions of the forbearance programs. So figured we might as well get to the forefront of that, point everybody in some directions of forbearance information, forbearance guidance, and then talk a little bit about, well, after my forbearance, what does my refinance look like? What does my purchase opportunities look like? And we'll talk about that a little later in the show. But so that's what we're going to talk about today. But before we do that, we're going to talk about rates. Rates.
My favorite part of the week. Let's go.
Woohoo! It's been a fun week. Let's just say that. I'm going to share my screen here. So mortgage rates are tipping back up. Freddie Mac's mortgage survey, mortgage rates move up. And let's just keep in mind, I want to be, Freddie Mac is saying 2.81 right now with a cost of 0.7, which I just want to remind everybody, this is trailing numbers. This is all the surveys that they did last week. So the stuff that's going to be published this week or is on market this week is actually going to be showing up in next week's numbers. So we're tipping up a little bit. There's been a lot of news with the change of administrations and some monetary policy. There's been some mixed messages out there, and quite frankly, there's a little bit of speculation on inflation. It's all about inflation. Are we going to see inflation? Are we going to actually realize it in the market and the treasuries and the bonds go up as far as offering a yield? So there's kind of this stop in the market right now as far as mortgage-backed securities are saying, and the bond offerings just aren't there to keep the mortgage rates low, which is kind of weird, because then when we look over at the Fed and the Federal Reserve saying, hey, and they announced yesterday that the outlook for a healthy economy is very far away, and we're going to continue our monetary stimulus of buying treasuries and buying bonds and mortgage-backed securities. So they're going to keep buying hand over fist right now. So that's artificially stimulating the mortgage market, the bond market, and the whole kit and caboodle. So there's a lot of mixed messages right now. And as a reaction, rates are ticking back up. To that point, keep in mind that this number is purchase number. Whoops, I'm not sharing my screen anymore. This number is on purchases here in the great US of the A. And so
historically, quick question. When they give us that weekly rate, is there generally points on there, or is it more of a par rate?
Yeah, no, there's generally points on there. That's a great question. Yeah, there's generally points on there. And that's where the devil in the details is, Stacy. A lot of people like, oh, 2.81, I should be getting 2.81, but then they don't look at that 2.81 comes with a cost. It's almost a point cost. So if you've got a $500,000 mortgage, it's almost $5,000, a third under that. So doing quick math, like $4,200. So it's important to watch this. It's important to know. What's also important to know that we were talking about a little bit before, this is the Federal Reserve database. It's a great database. If you guys are junkies and nerding out on data and you want some obscure data point, go to the St. Louis Fed FRED database and you can find whatever you want. So we were joking a little bit, not joking, but we were just contextualizing. Okay, so today we're talking about rates ticking back up to 3%. Just going back to the last 40 years of rates, I mean, look at this mountain that we've had. If you can't see that, in the 80s, 30-year mortgages were 18.27%. Okay, 18.27% in 1980. I'm going to put that in there. 18.27 on a 30-year fixed. 1 second. In 1980. That's huge. So when we talk about rates today ticking right back up to the 3% mark, let's put that in context. Let's understand that it's a great time to finance. It's still awesome out there. So don't hesitate. So now we get into the speculation side of it.
Well, wait, go back to that graph, Keith, because it's great to go back to the 1980s, but show where we're at, like in the last 3 months or even 12 months.
Yeah, last 12 months. Let's see where I got that in. That
when
is.
we say picking up, we're still like at the bottom.
So this is the last 2 years, right? Just a little short of the last 2 years. There we go. So 2 years ago, on January 17th, 2019, we were at 4.45. So any of those folks that have purchased in 2018, 2019, 2020, and my clients included, I'm getting back to them and saying, hey, yeah, rates are ticking up, but it's still a great time to refinance because you put down 5%, you put down 10%. Not only can we still find a better rate environment for you possibly, we can also get rid of that mortgage insurance, that great, awesome, cool tool that you use to get into that house with a low down payment. Now we can get you out of that mortgage insurance and we can also get you a better rate. That's a 2-for-1 special right there. That's what I call it. But yeah, so just as recent as 2 years ago, we were 4.5. So we're still 1.5 better than we were 2 years ago. Huge times in the mortgage market, which are just still awesome. So now we get to the speculation, Stacy.
Okay, ready.
You know the question. Anybody that's watching knows this question. So rate environment. Where are we going? Stacy says down.
I still say down. I mean, maybe up. Maybe we'll flatten for a bit, but I think we will. I think we're gonna stay low for some time.
Yeah, I don't know how much lower we're gonna go. I think we're really gonna trough out right around 3. That was always my speculation. Somewhere between 3 and 3.125 will be the stabilization of the mortgage market. And I'm gonna say something a little maybe not happy for some folks. Increasing mortgage rates would be a good thing for the purchase market right now. The purchase market is on fire. And I've got a client that made an offer on Monday, and they were over making an offer up in like the Redmond, Sammamish area on, a $900,000 house. There were 42 offers.
Wow.
42 offers. So rates, though are really low, increasing rate environment would actually help slow down and cool down the purchase market a little bit, because it would eliminate a few of the buyers out there, right? Higher rates means a higher debt to income ratio because your payment is higher. So if you don't have the down payment to offset that increase in interest rate, you may not be able to qualify for the loan.
But if you're talking about going from 2.7 to 3% or 3.125, that's not going to kick that many people out. But
that's not going to kick that many people out. No, it would have to be a pretty substantial move in interest rates to the tune of close to 0.75% to a point. So and we were talking about purchase money in the mid 2s, and now we're in the high 2s, right? You got to remember one difference between purchase money and refinance money. Thank you to FHFA and those fine folks over there for Fannie and Freddie. If you're doing a refinance, they're charging you a 0.5% hit to fee. So everybody that's refinancing right now is paying into Fannie and Freddie's coffers a 0.5% of your mortgage balance is now going to Fannie Freddie in an adverse market fee. So like it or not, it's still a great time to refinance. Still a great time to consolidate debt. It's awesome to do that. So definitely, if anything,
and
this
a great
is
time to buy. You just need to be patient, right? And keep putting those.
Come again?
Great time to buy as well. Just need to be
great time to buy. And let's talk about that, because I still hear it from a lot of folks out there in the market, like, oh, I think it's too hot. It's going to fall on its face. It's going to the housing market's going to implode, and that's a very visceral thing, because we remember 2007, we remember 2008, when the market was really, really hot and everybody was getting mortgages and everybody was buying houses, right? So it's kind of a little PTSD that we are going through right now in seeing these increased values. I want to say it was the coast to coast appreciation was almost 10% last year. The National Association's number, National Association of Realtors number, said coast to coast, if they averaged out all the appreciation in America, it was 9.8 something percent, which is crazy. That's huge. That means everybody gets to see almost a 10% increase on their values. And when you're talking about a region like ours, we're $800,000 average sales price. That's an $80,000 increase in your value of the house. Crazy. So here's how we got there. I love to share this stat again from Fred. We were talking about this, Stacy. Housing starts. There's only so many houses that have been built, right? So we need new construction to continue to add to supply because population is continuing to expand. And I share this with folks that have that concern that, hey, the market's overheated and it's going to fall down. And I go back to the very basics of economics. The basics of economics say supply and demand. They find equilibrium through price, right? So the National Association of Home Builders, their number to keep up with population growth says we need to go out there and build 1.1 million houses on an annual basis. We have to have that pace, right? So this graph that's up on the screen right now, this is showing you the annual pace of new home starts, single family new home starts in the United States, right?
And it's been that same number, the 1.1 for years, right?
Yeah, so this is a running pipeline number, right? So, hey, we are, as of today, we're on pace to build X amount of houses based on new permits and housing starts, right? So they haven't been issued a final occupancy cert. So we need to keep this annual pace that if we keep having these new applications for housing units, new applications across the United States, right? So we should be building a net of 1.1 million housing starts a year to keep up with the pace of births, immigration, and all that good stuff.
Yep. And where are we at?
So I'm hovering right now. I don't know if you can see that. I think you can see it if you expand your screen. I'm hovering at March 2007, which was the last time we were at 1.2 on average, or on a pace to build 1.2 million starts. Now, we all know what happened in 2007. 2007 was the deterioration of the mortgage market. And by just a few years later, by the time we get to March of 2009, we're at the trough. We hit the bottom. We're pacing at 350,000 new housing starts coast to coast, right? So we dropped to 1/4 of what we should be pacing at as far as housing starts. And now we don't recover this. We don't recover this for the better part. This is where it gets scary, folks. This is where it becomes very real, where we're seeing 10, 15% bid up wars. We don't get back over a million pace until December of 2019. We finally cracked the $1 million, we finally cracked the 1 million unit pace as far as what's in the pipeline and new permits coming into housing authorities and building authorities across the United States. So we spent the better part of 12 years not building enough housing units to keep up with the population growth. This is why we are where we are today. And this is why, and what I believe, why the housing market is not going to see a depreciating event, because of the basics of supply and demand. This is rooted deep. The reason why we had the huge run up in 2007 is because people that were not supposed to be into housing got financing through the mortgage world, right? That's why we got there. Here we have a fundamental supply and demand issue. So,
and then what happens? Because there's a drop after that December 2019.
oh, December 2019, there's a drop. Stacy, there's a drop in March and April of 2020.
Yeah, all the way down to 679. So I appreciate
Coronavirus.
what you were saying. I mean, we essentially lost a whole year of growth in that first quarter. During that 60 days, March to April. Yeah.
Yeah. Well, the cool thing is we're starting to make that up. This goes back. They haven't published January's numbers, but the new housing starts that I saw came out of NAHB is we're on pace right now for a 1.5 million year, which would be great. Until this equilibrium happens with the new home builders building more homes for us coast to coast, we're going to continue to see this pressure. We're going to continue to see this escalation in price because home ownership is still low. Home ownership is right there at about 64%, which is just about a 0.5% lower than the historical average. We as a nation run at about a 65% home ownership rate. So super crazy times. But yeah. Anyway, I can geek out on supply and demand all day, but I want to maybe switch topics.
Okay.
What's yeah. Forbearance. Some great news.
We brought this up last week, and I thought we were way ahead. Like, just putting it out there so that putting in the back of your mind that we're gonna have to talk about this in 60 days. And what happened? Like a few days later, we get an announcement.
Yeah, you're absolutely right, because that announcement, it came out. FHFA's announcement came out on the 9th, and then FHA followed suit this week. So forbearances have been extended as far as requesting forbearance from your mortgage underwriter, which there's still a huge amount of folks out there that have been impacted monetarily through their jobs and their employment, that they can no longer support their mortgage payment. And for them, there's that relief through the CARES Act to allow them to enroll in a forbearance plan. Really quick, I wanted to share the CFPB's website. This is a super awesome website. If you guys are in that place, or you know somebody that is in that place that needs some forbearance help, I'm putting it in the chat right now. Please start with the Consumer Finance Protection Bureau. Please start there. There's these 2 must-watch videos. We're not going to watch them today. 4 things to know about mortgage relief, and then the 5 steps to mortgage forbearance. Super, super powerful. The cool thing about the Consumer Financial Protection Bureau is when you look at Fannie Mae, when you look at Freddie Mac, when you look at FHA, they're kind of siloed in their own job duties. The CFPB is helping all financial institutions through this. There's a very set guideline for folks when it comes to the CARES Act. The CARES Act defined very specifically that forbearance will be granted to anybody that has a federally backed, federally owned mortgage, right? Underwritten by Fannie Mae, Freddie Mac, FHA, VA, and USDA, right? So all those underwriters, if you have one of those loans, you're going to get forbearance. Now, what this doesn't encompass, and where I'm starting to talk to clients that want to refinance or want to work through their forbearance agreements in different ways, is maybe they're with a credit union or a bank that portfolios their loans, right? They haven't securitized them. They haven't sent them to Fannie Mae, Freddie Mac, FHA, VA, right? So that loan doesn't technically fall under the CARES Act. So the CFPB gives you some great guidance to help you work through your mortgage servicer's checklist on how they're going to work out your forbearance, right? There's lots of things that happen. Forbearance is just the act of stopping your mortgage payment, not counting any negative marks against you during that forbearance period. And now the thing that we all need to understand, and it's said in the CFPB's video, is you need to understand what happens after forbearance is done. After you go back into a payment plan. Is it a payment plan? Is it a deferral? Right? Do you owe it all at once? Right? I worked with a gentleman that he was with a credit union. He came out of his forbearance and now he owes $28,000. Saw it right there on the statement, plain as day. Like, your next payment is $28,000. And so he's like, how can you help me? And at that point, he would have to make 3 on-time payments, and there's some workouts. But long story short, know what you're getting into before you go down that path. If you're in that path, continue to talk to your servicer. Let's talk really quick about scams. There's only one company that can give you forbearance. The company that is on your mortgage statement. Very clear, right? If you're calling or getting a call from somebody else that is not your mortgage servicer, do tread lightly, proceed with caution. The only people that can give you a forbearance agreement and the forbearance workout, whichever way that will be, is your mortgage servicer. So please, please, please get your mortgage statement. I thought I brought mine today to give you an illustration, but I didn't. I don't have it here. The number on your statement is the number you should be calling. Please do not call anybody else about setting up an agreement for your mortgage. There's lots of scams. We saw this in 2007 with the mortgage meltdown. We're going to see it again here through the forbearance workout and through COVID-19. I implore you, I plead desperately, if you're going to go through forbearance, call your mortgage servicer only, right?
Yeah. And if you still have questions, just call your loan officer or call just anyone you trust, even if they're at a different company, and they'll help you get to your servicer.
Yeah, we'll help you get to your servicer, because companies, not all companies hold on to their mortgage notes, right? They do sell them to servicers, and that servicing company provides all of the workforce and the accounting to track your payments and pay your insurances and taxes, right? So that servicer may not be the loan officer that you worked with, but call your loan officer back and they will direct you. They will help guide you to that place. We're not just here to make loans for you. We're here to help you get through your mortgage experience to the best of our abilities. So, but avoid the scams. If somebody is calling you about a forbearance, that is a scam. You have to enroll. You have to reach out to your mortgage servicer to enroll in forbearance. It is not mandated. It is not a given. You have to enroll in it. So super, super important on those pieces. Because again, the CFPBs, they're 2 videos, super great place to start. So
very easy to enroll would be my last caveat to what you're saying, Keith.
Say again?
It's very easy to enroll.
Yes.
So be careful. Just by saying yes, you might be enrolling yourself. It's not like filling out 20 pieces of paper. Because we've talked to clients who are enrolled and they didn't realize they enrolled. So
yes, yeah, and I've had clients who've enrolled, and they kept making their mortgage payment, and then they came to me and they're like, okay, let's do a refinance, and I'm like, oh, your credit report says your mortgage is in forbearance, and they're like, well, I called them just to see to explore what the options were, right? And that call triggered their forbearance. So definitely, to Stacy's point, it's super easy to get enrolled. Make sure that you're explicit in conversations that you're having. If you're just calling to figure out what your options are, somewhere in that call, you want to be very specific with that customer service representative. Thank you for providing me the options. I do not want to enroll in forbearance at this time. Otherwise, you may find yourself in forbearance. So let's talk about life after forbearance. Because wow, how did it get 25 minutes into this? This was
because we can talk for days about what we do.
I love what I do. It's awesome. I've got new T-shirts that we're gonna roll out. Here, let me show you one. We're talking about down payments tonight. I'm a huge fan of mortgage insurance, right? So I heart mortgage insurance. For all my mortgage insurance account executives, if you want one of these, I can send them to you. They're awesome. You know, they've got my mortgage team on the back. Anyway, but we're going to talk about down payments tonight on Mortgage from a Treehouse. But looking at life after forbearance, it doesn't mean that you guys can't go out there and not buy a new house, not refinance. There's just some hurdles and some things that you need to know. When you go into a forbearance agreement and then you come out of it, there's a couple resolutions. If you come out of your forbearance agreement and you pay it all back, right? Like my gentleman that I was talking to, I'm like, hey, you could just come current on your mortgage and pay the $28,000 back and you're eligible. Boom, right? You want to do that before you make application, right? So call us up, we'll talk about it. Okay, get it current, then you can make application and you're good to go.
Yeah.
The second step is you could be put into a payment plan or a deferral plan, right? And you need to reestablish the mortgage for at least 3 months on-time payments, right? If you reestablish the mortgage, you make 2 on-time payments, miss the third, and then the fourth one's on time, no dice. It's got to be at least 3 on-time payments, and there cannot be a missed payment since coming out of the forbearance lockdown time, right? In that case, you are refinance eligible. You need to talk to your loan officer on their specifics and how they can help you through that. Now, I'm talking very specifically about Fannie, Freddie, and FHA. I'm not talking about the jumbo market. So when we get above a 772 or 776, 250 loan amount, that's a completely different world. But the majority of us are still in that conventional loan limit world. The other thing that I've had people do is once you satisfy the forbearance, you're good to go. So I've had folks that would actually go out, list their house, sell their house, pay off the mortgage, pay off the forbearance amount, and then turn around and go buy a new house. You can do that.
Yeah, so the trick there is you have to pay it off, whether you're selling or you just maybe have the cash and you maybe didn't need the forbearance in the beginning, but regardless, as long as you catch yourself up prior to completing a loan application, you can move forward with a lender.
Yep, you're good to go. So there is life after forbearance. Great things happen, you know. And the other thing is there doesn't have to be an immediate remedy. In some of these deferral plans, you're not supposed to repay it until you get to the end of your term. You refinance or you sell the house. So you can just get back to life as normal. And that's what the true intent of the CARES Act was. Honestly, it was a little botched coming out of the gate when they threw it out there really quick because there was a lot of unanswered questions, but they have since ironed those out. I think I recall saying this in March, like, hey, forbearance, this is how it works in the normal market, but I'm sure they're going to adapt it as we get through this, but they just wanted to put it in place. So they put it in place, and this has been a very good tool to keep people in their houses and not homeless because they couldn't afford the mortgage because of some COVID lockdown. So it has been a helpful tool for our homeowners. Have conversations with loan officers. Feel free to give me a call. We could talk about your current situation and put together a plan. Once you have the plan together, it's no problem. So, oh yes, there you go. There's the Consumer Financial Protection Bureau's COVID mortgage and housing assistance URL.
Yeah, and if you go back to if you go to our YouTube or wherever you follow what we're doing, our video on forbearance about a year ago was really just to direct you towards educational sites. So it is still a valid video to watch. We weren't, to Keith's point, the rollout, you know, I think we had a dozen different changes of how the program worked in a 2-week period, but our video was not talking specifics. It was just directing you to websites like this. So if you want more information and some more educational websites to go to, I would loop back to that video, and there's lots on there for you to.
There's lots on there, and to that point, Stacy, stay on the government's website for the CFPB. You can go visit Fannie Freddie. They have information there. FHA does as well. HUD does. But go back to your servicer. Start with your servicer if you need it right now. There was just another 800,000 plus initial unemployment claims this week. That was just announced this morning. You know, so there's still a very real need out there for Americans and homeowners. So don't be afraid to use it. Just understand what you're getting into.
Definitely. Yeah.
Yep. So with that, we're already to a half an hour. We're here as resources too. If you guys want to talk through something, I'd be more than happy to. Stacy is here for you as well. Just ping us, DM us, what have you, and we'll help in any way, shape, or form. And feel free to share, like, and comment. Let us know what you think. Did you survive the snow? We had a little bit of snow. In closing, what did you do in the snow, Stacy? Just hang out?
Made snow angels and sledded and snowball fights and all of it. That's what we do, right?
That's what we do. It's here for a very short period of time, right? It's here and then gone. So you got to just live in the moment and go get it. So right on. Well, join us next week, everybody. Have a great week. Join us next week here, same time, same place, 10 a.m. Thursday mornings for Real Estate Now. And Stacy, until next week, enjoy.
All right, you too.